Welcome to another video in which we're going to talk about accrual accounting. For the Principles of Accounting textbook, this is chapter 4. In this chapter, we are looking at the fifth step in the accounting cycle. To recall, in the first few steps, when we have a business transaction, we analyze the transaction to see if it's an accounting event. If it is an accounting event, that is, you have two or more accounts that are affected, we will journalize the transaction in the general journal. At the end of the accounting period, you will post it into the ledger. After all journal entries have been posted at the end of the period, we close all the accounts to find the balances and prepare the trial balance. Now with that, we can prepare our financial statements. However, now we are looking at something new in this chapter, accrual accounting concepts. And we see that there is a need to journalize and post adjusting entries as it relates to deferrals and accruals before we can prepare the adjusted trial balance. This is what's used to prepare financial statements. So let's look at these words deferral and accrual, see what they mean. Or let's step back a minute and say, what does accrual accounting mean? So accrual accounting basically means that a company's transactions are recorded in the periods in which the event occurs, even if cash has not exchanged. So the work has been done, the expenses have been incurred, cash may not have been paid in the current period. We'll see that timing issue, what happens. Now, as opposed to that, there is the cash basis accounting. In this, you're going to record revenues only in the period in which you receive cash. You will record an expense only when you pay cash, in the period in which you pay cash. Cash basis accounting is not in accordance with GAAP. Therefore, we're not going to talk about cash basis accounting again. We're going to stick with accrual accounting. So let's see what are some of the reasons we need accrual accounting, what gives rise to accrual accounting. So scroll down a little further here. So we have the periodicity assumption. So in accounting, we basically create time periods. So this is similar to if you start college and your parents want to know, how are you doing in college? Well, you could say, I'm doing fine. It's a learning process. It's lifelong learning. But they want to know how you're doing now. When they talk about now, what do they talk about? Typically the semester. How did you do in the fall semester? How did you do in the spring semester? How did you do for the year? So the periodicity assumption is the same thing for a business. The economic life of a business is divided into artificial time periods. So all businesses prepare their financial statements at least once a year, that's annually. All publicly traded companies are absolutely required to prepare and present their financial statement to their investors once a year. In fact, publicly traded corporations are also required to prepare quarterly statements. Companies prepare monthly statements. If you're a small business, you would probably even prepare weekly statements to see how you're doing, because time is of the essence. I can't wait for a whole year to find out I'm not doing well. I need to know now. So we'll be looking at annual financial statements. So when we talk about an accounting period, we're talking about 1 year. Now, companies do not have to have their year end at December 31st. It has to be 12 consecutive months. So it depends the industry in which you are. So for someone who can make it easy, that is, they can just decide what their year end is, a manufacturing business, they're doing the manufacturing. Most manufacturing businesses in this country have December 31st as year end. If you go into the agricultural business, what makes sense for them is September 30th. It's the end of the harvest. That's when they do it, end of summer. That's their year end. If you look for retail businesses, they do their year end the last week in January or the first week in Feb, because they have their Thanksgiving sales, their Christmas sales, all the returns that happens, and it's logical for them to close their books in Jan or in Feb. Most of the problems we are going to be looking at, it's going to be December 31st, but always watch out for the year end, what it is. So now that I know that my life is going to be broken up in years and I need to assess my performance each year, I will look at the revenue recognition principle and the expense recognition principles. These are guiding principles for us in accounting. So the revenue recognition principle, when you're looking at accrual accounting, says that revenue should be recognized in the accounting period in which the performance obligation is satisfied. Lots of words over here. What it basically means is The period in which I delivered the goods and services to my customers and clients, that's the period in which I'm going to recognize revenues. The customer may have paid me before the period, during the period, or after the period, the accounting period. It doesn't matter. I did my work in the current period, therefore I recognize revenues in the current period. If I didn't do the work in the current period, I can't recognize it as revenues. It'll be unearned revenues. Now, expenses. Expenses are basically the cost of doing business. To put it quite simply, you need to spend money to make money. So what are the typical ways you would spend money? For even something like an accounting business, you have to pay for rent. You need to have an office where your clients can come in. I pay for rent, I pay for all my utilities. All of these expenses, either directly or indirectly, are going to help me generate revenues. So you recognize expenses with the revenues in the period which the company makes efforts to generate those revenues. So this is a matching principle. You want to match the revenues and the expenses to the period in which the revenue was generated. Basically saying if I have revenues, my expenses also were incurred at that same time, I need to recognize it over there. This combination of revenue and expense recognition is in accordance with GAAP. So what we have looked at over here really is the fundamentals of the accrual accounting concepts. So let's put this to play with an example. So our textbook has an example over here. They have an activity. We are Fresh Colors. We purchased paints, we painted a building, and we paid our employees all in the year 2021. Who is Bob's Pizza Barn? They are our customer. So we did the work for them. So we incurred all our expenses over here. They paid us for the work the next year in 2022. In 2021, they didn't pay us. They paid us the next year. So what's the difference between accrual accounting and cash-based accounting for the exact same business? So if Fresh Colors is using accrual accounting, in the first year, they're going to recognize their revenues at 80,000 because they earned the money. They did all the work. The performance obligation is satisfied. So 80,000 is going to be recognized. They incurred all the expenses in order to generate that revenue in the current period. So they recognize 50,000 as expenses. Revenues minus expenses gives them a net income of 30,000. Nothing is left for the following period in terms of revenue and expense recognition. There was cash that was received, but we're not going to worry about that right now. Now, if I was using cash basis accounting, what would happen? I incurred all the expenses, I paid for it, so that 50,000 is still there. But I don't recognize anything as revenues in 2021 because my customer didn't pay me. The next year when the customer pays me, I recognize the revenues, but I don't recognize any expenses. Now the net effect is the same over a 2-year period. So my total revenue is 80,000 plus 0 is 80,000. Here it's 0 plus 80 is 80,000. Expenses 50 plus 0. And here it is 50 plus 0, the same thing. Look at the net income number. 30,000 in year 1, 0 in year 2 for a total of 30,000. In the cash-based accounting, I have a loss of 50,000 in year 1. And I have a profit of 80,000 in year 2. When you combine the two, you come up with the same 30,000. So this periodicity assumption, what we do is in accrual accounting, we say we have 2 years, 2021 and 2022. We split the 2 years and we say, where did we earn the revenues? When did we earn the revenues? When did we incur the expenses? That's a timing issue that we're concerned with over here in this chapter. So we're going to go through a whole problem and look at this, but let's again look at some of the things that follow through from here. So what happens is we have the need for adjusting entries. These are book entries. These are not backed by a transaction. A transaction is what we looked at in the previous chapters, where we actually transacted with an outside party. These are adjusting entries, which means we are going to do it internally in our books. So adjusting entries ensure that the revenue recognition and expense recognition principles are followed. They're required every time a company prepares financial statements. A company analyzes each account in the trial balance to determine whether it is complete and up to date for financial statement purposes. Now, this last sentence is very important. Every adjusting entry will include one income statement account and one balance sheet account. So again, let me repeat that. Every adjusting entry will include one income statement account and one balance sheet account. So what are the types of adjusting entries? We have two types of adjusting entries, deferrals and accruals. So deferral means I'm going to defer the expense or I'm going to defer the revenue, the recognition. So why would I defer? Cash has been exchanged. So a prepaid expense, I paid the cash ahead of time. I have not yet incurred the expense. So a very good example for this, a very common example is when you pay for your car insurance. We typically pay 6 months at a time or at least a quarter at a time. I'm going to get the benefit over the next 6 months. I may pay a 2-year insurance policy. Sometimes companies prepay rent. So all of these are prepaid expenses. Another good example is supplies. When a company buys supplies, as an accountant, I buy paper, pens, ink cartridges, etc. I'm just buying it for the next year or two. At the end of the period, I assess how much I used, and that becomes expense. But right now, I'm not going to recognize it as an expense. I'm going to defer the recognition. Right now, I'll call it an asset. It's going to be a prepaid expense. Along the same lines for revenues, if my customer paid me in advance, they paid me the cash was received, but I've not done the work. I can't call it revenues. I have to defer the revenue recognition. Right now, I'm going to call it unearned revenues. Accruals, on the other hand, the work has been done. Okay, so either I did the work, the performance obligation, or I got the benefit of the work from someone, but I have not yet done the recognition. So revenue for services performed but not yet received in cash have to be recorded. So at the end of the period, I tell you a customer has been billed, they will pay me next period, but the revenue has to be recognized right now. Similarly, I find out that I got the benefit of something and I still have not paid the money. I've not even recognized it. I need to recognize it now. Best example is your salaries and wages expense. You need to do that the expense recognition in the current period because you already got the benefit of the employee's work. You just have to pay them in the future. So it's a timing issue. So for deferrals, we have received the cash or we have paid the cash, but the corresponding revenue or expense is not going to be recognized right now. We're going to defer the recognitions. Accruals means it's already happened. The revenue has already been earned, the expense has already been incurred, but that cash payment or cash receipt part, that's going to happen in the future. So with that, let's look at the homework problem that we have. And we're going to look at this problem, see what has been given to us and what's being asked of us. So here we are told that Len Kumar started his own consulting business, Kumar Consulting, on June 1st, 2022. The trial balance at June 30th is as follows. So this is only for 1 month. We are doing all the accounting for the month of June, at the end of June. So all the journal entries, the transactions that happened have already been journalized, resulting in this trial balance. Now, I highlighted the word cash over here, the account cash, and I'll tell you why I've highlighted that in a minute. Then they tell me that in addition, these are the following accounts that I need to open. And I need to open these accounts because they're obviously going to be affected in the accrual process, the adjusting entries. They've given me 7 pieces of information that require my attention by way of adjusting entries. Okay, so I will do those 7 journal entries over here on June 30th. All of them happen on June 30th. They've told me after I do my journal entries, I need to post it into the T accounts. So I've opened all the T accounts, and these are all the beginning balances that I'm going to put over here, which was from my unadjusted trial balance. And then after I'm done with the journal entries, adjusting entries, and posting it into T accounts, closing these accounts, I'll put them in over here. And now you will notice that I've left some spaces over here in addition to the account names I already had. And only cash is the amount that I brought forth over here. So one of the things to keep in mind when we do adjusting entries is adjusting entries typically are not going to affect cash. There are only 2 times that cash may be debited or credited when we are doing adjusting entries. One is when you do a bank reconciliation statement. You will see this in a subsequent chapter. And if there are any adjustments that need to be paid to cash, and this is typically coming after you've looked at your bank statement and there's something that you had not done over there. The second journal entry that would affect cash in the adjusting entry is if you're doing an error correction. So error correction, we will look at it, but it's really out of scope for the principles class. You see that more in the intermediate and advanced class, accounting classes. We will see the one that comes from bank reconciliation. But unless you see a bank reconciliation, information from bank reconciliation, adjusting entries will never affect cash. In this particular problem we're going to work on, cash is not going to get affected, which is why I just highlighted and told you that cash number is going to stay the way it is. All the other accounts you're going to see are internal, one balance sheet and one income statement account. Okay, so let's quickly look through these accounts, this other information, and see what needs to be done over here. So they tell us that supplies on hand at June 30th is $720. So if you look at supplies over here, we had purchased $2,000 worth of supplies. I now have $720 worth of supplies remaining with me. So what happened to the difference? The difference got used up, and to the extent it's used up, it became an expense. So my journal entry over here on June 30th, they're all going to be on June 30th, is going to be supplies expense debit, supplies credit. So I decrease the asset. Remember, supplies is an asset. It's a balance sheet account. Supplies expense is an income statement account. What's the amount? It's not 2,000. It's not 720. It's the difference between the two. 2,000 minus 720 is 1,280. That's how much was used up. And that's how much I need to debit the supplies expense and credit supplies. Just for this one, I'm going to do the posting immediately to show you what the effect is going to be. So supplies is going to be credited 1,280, and supplies expense is going to be debited 1,280. Now again, just for supplies, I'm going to do that's the only information relating to supplies. So if I had to close this account down, take the difference between the two sides. So I'm going to look at the total debit minus the total credit and put the difference on the debit side. This number is the balance. That's what I was told. I'm left with 720, which is why I had to credit supplies 1,280. Now, if they had told me I used $1,280 worth of supplies, then that's a number I would have used in the journal entry. I didn't need to do any calculation. Let's look at the second piece of information. A utility bill for $180 was not recorded and will not be paid until next month. Okay, so in this case, I have utility expense. The amount is $180. I've incurred the expense. I need to recognize it right now. I didn't pay cash for it right now. If I had paid cash, it would have been a transaction. It would have already been taken care of. I owe this money. What should I credit? I need to credit a liability, a current liability, because it's a short-term liability. I'll definitely pay it off within the next 30 days. I have a choice of crediting utilities payable or accounts payable. Companies will typically use accounts payable simply because it's easier. Otherwise, I'm going to have multiple payables in my books. And also a key for me over here was they gave me the names of all the accounts that I need to create in addition to what was over here. There was no utilities payable over there or in this list. That's how I knew it was accounts payable. That's when it becomes helpful when you look at this list of accounts that they tell you what account names to use. Subsequently, you will get used to coming up with the account name. Again, if you had written utilities payable, it would not be incorrect, but on Wally Plus, it will mark it wrong because there is no utilities payable. It'll be accounts payable. Okay. Now, the next the next piece of information says the insurance policy is for a year. So again, let's look over here. My prepaid insurance is $2,880. I'm doing the adjusting entry for the month of June, at the end of June. So 2,880 divided by 12 is the current month's expense. So it's going to be insurance expense debit, prepaid insurance credit, and that amount is going to be 2,880 divided by 12, which is 240. $240 is going to be my insurance expense. That amount has become an expense and my asset has decreased. So similar concept as my supplies expense. Then I'm told that in number 4, I perform services for $4,100. Services were performed for $4,100 of the unearned service by the end of the month. Okay. So I had unearned service revenue of $5,200. Of this, during the month of June, which means this customer had paid me in advance. Now on June 30th, they're telling me that I did do some of the work. How much did I do? 4,100 worth of it. So I need to do an adjusting entry for 4,100. I have unearned revenue, 5,200. Should I debit or credit it? Let's think back. It's a liability. If I credit it, I'd be increasing it. No, actually my liability has decreased, so I need to debit it. I will debit unearned service revenue, 4,100. What I'm going to credit is service revenue. This is no longer unearned, it has become earned, so it's service revenue. The next is salaries of $1,250 are accrued at June 30th. This is fairly straightforward. Salaries and wages expense was 4,000. They are saying there's an additional amount that has been accrued, okay, which basically means I owe this money. Now for salaries and wages, we always have a salaries and wages payable because this is to employees. We want to keep this in a separate account. You need to know when you have to pay your employees, how much you have to pay them. So that one, you will not lump it with accounts payable. You're going to keep it separate. Salaries and wages payable. So my salaries and wages expense has increased to the extent I've accrued it at the end of the period. The next piece of information says that I have an equipment that has a 5-year life. It has no salvage value and is being depreciated at the rate of $250 per month for 60 months. This is something we're going to go into great detail in a subsequent chapter on long-term assets. So right now, let me just give you a quick overview. When you purchase an equipment, no different than supplies, you book it as an asset. Supplies, typically you expect to use them up within the year. Equipment is a long-term asset. I'm going to keep it for more than 1 year. In this case, it's 5 years. Something like supplies, I can actually physically see how much of it I've used. In equipment, it's really not possible to do that. So instead, companies will just come up with a method of how they're going to spread the cost over its life. That spreading the cost over its life is called depreciation. It's an accounting method. That's all it is. Depreciation is an accounting concept over here. So in this case, they've told me it's $250 per month. So that part is easy. So my journal entry is very straightforward. Depreciation expense debit, accumulated depreciation credit. Now, if you notice, I have only one long-term equipment, asset equipment. If I had a couple, let's say I had furniture and fixtures and I had some other asset, let's say a building, I would depreciate each of them separately. And I would have accumulated depreciation for each of those accounts separate. So in this case, I didn't say accumulated depreciation equipment because there was only one long-term asset. I also know the amount, it's $250 because that was given to me in the problem. And finally, I have invoices representing $3,900 of services performed by Kumar, that's my company, during the month, not having recorded as of June 30th. So here what we are saying is I did do the work. In the current month, I have not yet done the journal entry. So my journal entry, I know I have to credit service revenue. I did the work. Did I get paid in the current period? Obviously not. I'll get paid in the future. So the account I'm going to debit is accounts receivable. So once again, let's just recap for each of these journal entries. If we had one income statement account and one balance sheet account. So you need to see a revenue or an expense, the income statement account. So I have supplies expense, utilities expense, insurance expense. Here I have service revenues, then I have salaries and wages expense, depreciation expense, and then again service revenue. So I do know one income statement account is affected in each of these journal entries. Let me see if it was an asset, liability, or owner's equity that is affected in the the balance sheet account, what's affected? Supplies is an asset, accounts payable is a liability, prepaid insurance is an asset, unearned service revenue is a liability, salaries and wages payable is a liability, accumulated depreciation is a contra asset account. It's in the balance sheet. It's a subtraction from a long-term asset. Accounts receivable is an asset. So we have followed that accounting rule that in the adjusting entry, at least one income statement account and at least one balance sheet account must be affected. Also, you will notice cash was not affected in any of these adjusting entries. So our next step after we have done our journal entries over here, adjusting entries, is to carry the information, post it into the various T accounts. So I will go through that quickly over here. And what you will see again is common stock was not affected. I'm going to draw a double underline under the accounts that were not affected. And they are few and far between, but let's go ahead and do that. So we have account under assets, we have cash and equipment that I know that was not affected. Common stock was not affected. And then all these other accounts we'll see as we go along over here. So supplies expense, we already saw that one. Utilities expense debit, accounts payable credit, utilities expense. Then we have insurance expense debit, prepaid insurance credit, prepaid insurance is credit, insurance expense is debit. Then we have unearned service revenue debit, service revenue credit. We have salaries and wages expense debit, salaries and wages payable credit. Okay, then the next one is depreciation expense debit, accumulated depreciation credit. And finally, we had accounts receivable debit and service revenue credit. Okay, so now when we close all these accounts, as in find the balances in the accounts, we're not closing the accounts, we're finding the balances in the accounts. You're going to see the balances for each of these accounts need to be updated. Some have increased, some have decreased. Rent expense, there was no change. Okay, so we're almost over there with our account balances. One last one over here. Okay, now that we have all these balances, we are ready for the next step. What's the next step in the accounting cycle? I will prepare my adjusted trial balance. So I bring all my balances over from here. Now, after equipment, I put in accumulated depreciation because it's a contra asset account, which means it's going to have a credit balance. I added one payable, salaries and wages payable. So I brought that here under the other liabilities. Common stock, there was no change. Service revenue, if you noticed, you had 8,300 to start with. Now you have 16,300. That's good. Your service revenue, your revenues have increased. We added more expenses to the list. And when I put all of them in over here and bring all the balances over, I have a total of 45,310. As with all the other exercises, they gave me a check figure. My total trial balance is 45,310 and my service revenue is 16,300. That's something we looked at earlier, 16,300. So we are good with our check figures. So again, to recap what we did over here, if you go back to your accounting cycle, in the first 3 chapters, we learned the process of analyzing business events, journalizing accounting events, posting into the ledger. It can be done real time or batch posting. We then prepare the trial balance. At the end of the period, we will do the adjusting entries, which is what we went through just now. After you've done the adjusting entries and posted into the T accounts, and again, close your T accounts to find the balances, you prepare the adjusted trial balance. This is what's used to prepare your financial statements: the income statement, statement of retained earnings, balance sheet, and then also the statement of cash flow. After that, you're done with this financial statements. The accountants will do the closing entries. I'll talk quickly about the closing entries. Okay. So before I close my books, I need to know what I'm going to close. This is not just finding out balances and accounts. I'm closing it as in I'm going to make it a zero balance. All your accounts that you have, income statement, balance sheet accounts, your revenues, expenses, assets, liabilities, owner's equity, are classified as temporary or permanent. Your income statement accounts, all revenues, all expenses and dividends, they pertain only to a period in time. That periodicity assumption that I made at the start that I talked about, that's basically saying you're talking about revenues for the current period. So these accounts are going to be closed and they become zero balances. And what you saw in those financial statements in previous chapters is from the income statement, you went into the statement of retained earnings and you took that number over into the balance sheet. So that's the same thing we are doing, but we are formalizing it by way of a journal entry. Your balance sheet accounts are permanent and those don't close. They stay the way they are. So all my revenue accounts will be close to an account called income summary. All my expenses will be close to income summary. Then the income summary account will be close to retained earnings. Dividends are close to retained earnings. So what exactly does this mean? What's a normal balance for all revenues? They're credit balances. So in the closing process, I will debit all my revenues and I will credit income summary. What effectively happens is all your revenue accounts will become zero. Once I post the closing entry, those accounts will all be wiped out. They'll become zero. My expenses, I will debit income summary and I will credit all my expenses. Remember, expenses, normal balance is debit. By crediting it, I'm closing all of those accounts. Now that income summary account, there were 2 journal entries, the 2 that I just talked about, that created this income summary account. Whatever is the balance in that income summary gets close to retained earnings. So income summary, debit or credit, depending on what the balance is, whether I have a debit balance or a credit balance. And retained earnings will be debited or credited, the opposite effect of whatever you did to income summary. Dividends, normal balance is debit. So in order to close it, I'm going to credit it. Retained earnings debit, dividends credit. So at the end of this period, once I do my closing entry and I post it again into the journal, into the T accounts, and then prepare the post-closing trial balance, which accounts are going to be left in the post-closing trial balance? Only my permanent accounts. So I start next period with fresh temporary accounts. When I say fresh, I mean they all have zero balances, because accounting period says, I just want to know what happened in the current period. So think about this process as your GPA. Each term you earn a GPA, what happens to all those grades? They all move into your cumulative GPA. The next period you start with fresh grades. It's like getting a fresh start. Now your cumulative GPA from the past is still there with you. So you still have all these permanent accounts with you, especially that retained earnings. That's showing the previous performance. It's bringing that over. But all your income statement accounts, you have a fresh start. They all have zero balances. So that effectively will finish the accounting cycle. So once again, take a look at the problem and work your way through it. Go through this slowly. And if you're not sure of what account names to use, read the problem. For the most part, you're given hints. You're told what account names to use. So you don't have to get creative as yet. Just go through it slowly and you should be able to do this problem. Once again, we have just reviewed the accounting cycle and finished our the process of the accounting cycle, coming to the last step so that we can do the start the process all over again in the next accounting period. With this, I'd like to say thank you for watching this video, and please do ask me questions if you have any.